Hi, I'm Lynn Adams.
I'm Justin Gross.
Thank you for joining us for this edition of our Video Insight. This is our first quarter conference call for 2018. We want to take you through some of the highlights for year-end 2017 and talk about some things that are going on in 2018. Everything on the call is really for educational purposes only. It's not intended to be investment advice or tax advice, although we are going to talk about some tax issues today. With that, we're going to get started. 2017 was a good year.
Good year.
We had essentially every investment sector that you could participate in really did well. I think
Without volatility.
without volatility.
Go up, no volatility. I think first year ever, every month was higher than the previous month.
That's pretty interesting, right? I mean,
Yeah.
to go up as much as it went up
Right.
and not have volatility is very unusual. In terms of some of the specific numbers, the most amazing sort of best returns were outside the U.S. Emerging markets were up 37.8%. We took a heavier position in emerging markets around the end of February, so we were fortunate to capture quite a bit of that for our clients. Outside emerging markets, even like the EFI, the developed markets, were up 25.6%. The U.S., lagged the first half of the year by a noticeable amount, but then
Right.
the second half really sort of accelerated and then ended up 21.8%. So good year even in U.S. markets for large stocks. Smaller companies were at 14. In the hedge fund world, the typical hedge fund position was up 5. The bond market, if you look at the composite, even that good year, 3.5% for bonds in a yield environment that we're in that's pretty good.
Right.
And then commodities managed at the end of the year to turn positive. It was negative for a bit, but finished out positive. So low volatility, high returns, every sector was positive. You just wish every year could be like that, huh?
That'd be nice. It doesn't work that way though.
Unfortunately, a lot of that is a result of just pure earnings growth, right? So when we look forward and we kind of look at what the analysts that track the different industries are looking at, this shows us where, the next 12 months, each industry group, each analyst are saying we think that these companies can produce, upwards and upwards. So the third quarter 17 estimates for earnings were 31, 32 a share. They're pushing $35, $37 a share in the quarters that they're projecting for next year. So that's based on what orders are in the pipeline, what companies are doing with their costs, their hiring and firing. So the belief is that things are going to continue to improve on the earnings front, which is partially why stocks have been priced up so rapidly to this point.
Right, and a lot of moving pieces. Obviously, pending legislation, which is now law, gets factored into some of those estimates. But a lot going on, and that makes the lack of volatility even stranger. But
Right.
But okay.
So this next chart, we kind of titled it "Trees Don't Grow to the Sky." I really just want to make sure that people don't set their expectations that what we just experienced is going to be normal. It is. There was a convergence of so many factors that influence earnings, and many of them are one-time factors. Energy went from being negative to positive. Global manufacturing spiked up; it had been suppressed for years. The European political situation got clarity. The region sort of unified behind the currency. Europe picked up. The Far East started manufacturing, and natural resources prices gave them a bump. A lot of things happened at one time, and then the U.S. companies just maximized on the opportunity. And at the end of the year, we got the proverbial cherry on top of the sundae with this in very, very deep tax bill that is going to provide earnings growth for companies. So just the point is, don't get used to that.
Yeah, it was kind of the perfect storm. And we talked about, even with the global manufacturing, the heat index that we talked about recently in our last conference call, everything was kind of moving in tandem together to create 2017, and it's the exception, not the norm.
That's correct. I do think it's probably worth mentioning, all that being said, that if you look at this next slide, the U.S. has come from peak to trough, back to peak. We're up 295% from the last bottom, right, back in 2009. The world markets have only recovered 127%. So the price of stocks outside the US is noticeably more attractive from a valuation standpoint than the stocks in the US. So we continue to have more exposure there than historical averages because we think there's more value there. So I do think if we do continue to have positive things, looking outside the US is probably a smarter way to participate.
Yeah, I mean, you never know the future, but you could look at that and say maybe there's more room to run, there's higher dividend yields, there's better valuations, which all make the case to not keep all of your assets domestic, to look globally.
Right. Okay, so that was just sort of a note we want to make sure that we threw in there because we do like the international space, but we're going to move on because there's more to talk about with what's going on with in the U.S. Before we get to sort of the big story, just a note on bonds. So in the bond market, you know, the U.S. aggregate yield is in the mid twos. We're the highest in the developed world. So there's still a lot of foreign savers looking to use U.S. bonds as a safe haven, and I think that's helping to sort of hold rates stable. But we're still in a pretty low interest rate environment around the globe, which is good for, you know, companies to borrow money and to grow their businesses. Cheap money means it's a good thing for global growth. So we're creeping up from where we were in the last couple of years to be in the mid twos, but still one of the highest yields in the world on our bonds. Okay, so the 800-pound gorilla in the room in any financial planning economist discussion is the new tax law. So the Tax Cuts and Jobs Act, and this is a vast law. So there's no way in a 10-minute, 15-minute conference call that we can really get into this too deeply. But I'd like to run through some key pieces and help you connect the dots to some of these pieces and how that's impacting the stock market, because that's really what investors are interested in, right? So the headline items on the law are pretty simple, right? Standard deduction is now going to be $24,000 for a married filing joint couple. It used to be $12,700. They did away with the personal exemptions, so if you had a family of four, it really doesn't change a whole lot because your exemptions plus your deduction wasn't much different than where we're going to be now. But the standard deduction being at a higher number, what it will mean is that people that spend 90% of what they make will have more reason, they'll have more to spend at the lower income levels, right? Lower income levels tend to spend more of what they make. It's just how the system works, okay? So the standard deduction will also, being higher, make it so that a lot of people won't have a reason to itemize. So a lot of things that you would get credit for from itemizing, those industries might get hurt. You know, if you're not spending money on things or, you know, that are impacted by your itemized deductions, there's some cost consequences there. Child care tax credit has been increased. All the tax brackets have been lowered by 1% to 3%, depending on where you're at. So everybody's going to see a little bit more money in their paycheck, if you're getting a paycheck, you know, which all but 4% of our culture is because we have really low unemployment. But that more money in your pocket will help certain industries more than others, right? Corporate tax is really the gift to all of our investors, right? Corporate tax being reduced from 35% to 21% is a huge win for people who invest in corporations, who own corporations. Right. So let's walk you through why. Why is that? Okay, because I'm not sure that everybody understands that. So we just made this little hypothetical example to help illustrate why the corporate tax rate being reduced impacts you and I as a stock investor. Okay, let's say you have a company that's selling for $180 a share. Right now, price to earnings ratios are about 18 times earnings, okay? So company is selling at 180, it's making $10 a year, okay? Now these earnings are reported in after-tax basis, right? They're actually, that's what the investors want, right? So $180 price, $10 in earnings, 18 times earnings is the multiple. If you look at the companies, how did they get to the $10, right? So their earnings before interest, depreciation, taxes, and amortization, company has to make $15, right, before these pieces and have a corporate tax rate at 35% to net $10, okay? So this is how the relationship between the price, the multiple, the earnings, and taxes would work, okay? Now, let's say that a company is making that $15 before interest and deduction and taxes, okay? But we change the rate to 21%. So if you do that, and we didn't, we round it up or down, we want to keep it simple. If you take that $15 of earnings and you put it at 21%, now you have after-tax earnings of 12, right? So if you take that $12 and you multiply that times 18 times earnings, which is the multiple investors are paying right now, then that changes what the imputed price of that same company should be to $216, right? So the difference between $180 and $216 is about 20%. Does that make sense? Everybody clear, right?
I think so.
So now here's the thing. Companies may choose to spend more of that money and make it so that the after-tax that they're going to deliver as earnings to shareholders is the same as was before and spend more money, right? And if they spend more money, then that's investment spending, and that would, potentially increase their revenue growth in the future, or they may pass it through. We don't know what they'll do, but on the whole, if nothing else changes, you could expect a 20% increase in the value of stocks of companies that are impacted by this rule.
Yeah, and we're not necessarily saying that you'll see a 20% bump from here going forward. How
Right.
much of that was baked in?
That's right.
That this law would become, that this bill would become a law.
Right.
Who knows?
Well, and it's interesting, like from December 1st to now, essentially, stocks have been priced up about 8% in the U.S. S&P 500. I think that most of that 8% is because of this tax rule. Like that was around the time that we began to have a consensus that, hey, this law could pass, right? So some of that's already baked in, we think. Hard to know precisely, but just conceptually, I think it's important for people to understand that is what's propelling a lot of this market right now at this moment in the U.S., right? So, but tax cuts, that's sort of a broad scope. Let's look just for a few minutes at some of the more narrow pieces, okay? So the U.S. small company stocks tend to be domestic and not operate overseas and would not have exposure to international tax rates. So we think they will actually get the full force of the tax cut, right? Because more of them operate here in the U.S. We think the companies that operate in consumer staples, consumer discretionary, and financial companies, they will benefit because when the average American has more dollars in their pocket to spend, those are the sectors that tend to benefit.
Right.
They benefit from consumer spending. The telecom media retail group, sometimes in that area, they have large expenses that they buy big assets and things, and the new rule essentially is going to sunset a current depreciation expense provision that in the next 3 years or so, these companies will be able to make these big ticket purchases and deduct them immediately, and then it's going to go away. So we may see some accelerated activity in those areas taking advantage of that rule for the next 3 years. Here's an interesting area is the schools, right? Private school and religious schools. They changed the provisions on 529 plans that you can take 529 proceeds and pay for your local private school, your local Christian school, or your local religious school. There's a lot of people that have a lot of money in those plans, and they're paying a lot of money for these tuitions that now that they can take that money out of those plans and pay that bill, that'll free up more dollars. They can spend it on other stuff.
Potentially tremendous planning tool.
Absolutely.
That they could use, and there's things like that all throughout this bill that certainly we hope to be able to help you with.
Right.
But that's a big one.
It's a very big one. Manufacturing, we think manufacturing will benefit because they'll expense some large ticket items in the next 3 years as well. Some REITs will do the same. So those are some potential, even more, I guess, bigger winners potentially than just the overall averages. Now there are some sectors and some individuals that will get hurt, right? So these are some of the potential losers that are coming from this, right? So high income earners and particularly high-income earners that own high-value property. The state and local income tax / property tax that we have historically seen being able to be deducted on the Schedule A is now capped at $10,000. So, you know, many of our clients pay more than $10,000 in state income tax all by that just alone, not to mention, you know, property taxes and state and local other things. So that being capped is going to hurt people who have high value property and high incomes, right? I think that interest sensitive bonds potentially get hurt here, not immediately, but perhaps later in 2018. This bill is intended to stimulate growth and stimulate the economy. If it does, the Fed will probably have to accelerate their plans to raise rates so we don't get inflation. Obviously, if you own interest-sensitive bonds and rates go up, then that's a bad formula. Municipal bonds, you know, we think that if tax rates are generally lower, the intrinsic value of taking a lower yield to get tax-free is less attractive. Right?
Lower taxes equals less attractive tax-free yield, right?
Right. So munis might get hurt. Here's another one. I think this is very important, and as a planning tool in particular. The new law says if you have a home equity loan, if you go out and get a new home equity loan, it is no longer tax deductible. The interest is no longer tax deductible. So, you know, I think about the home builders that are out there and the home goods supply stores and things that people renovate their houses and they go out and they buy a bunch of stuff using, you know, home equity lines. There's going to be less people getting home equity loans because they can't deduct the interest. I think that's a really important thing to understand. There's going to be sectors hurt by that. I think the mortgage industry will get hurt by that. If you can't refi every time rates drop a little bit because now the new loan's not deductible but the old loan is, less people are going to be refinancing. Another couple things, publicly funded charities. If you have 50% more Americans using the standard deduction because the thresholds are higher, that means 50% more Americans are not going to be itemizing their deductions. If they're not itemizing their deductions, that charitable contribution isn't deductible.
And certainly we hope, and we've talked about, that's not the only reason someone would give, right?
That's right.
To the charity of their choice. But make no mistake, it's on the minds of directors of charities and things of that nature that you're going to lose. If you lose that tax incentive,
you're going to lose some giving.
That loses you some incentive.
Yeah.
So it's
and there are some other ways to give strategically through the planning process that you can still get tax benefits and things, but it's really kind of individual situations to help you figure out the strategy to do it. But that's a big deal. So public funded charities will probably be impacted by this. Another thing that's going to go away is in the next 2 years, they're going to change it so that if you're spending a lot of money on your health insurance, in excess of 7.5% of your adjusted gross income, you've been able to itemize that and deduct it. That's going away. It's going to sunset out 2 years from now. So the impact of that not only would be that you might pay more taxes on money that you're spending on your health care, but the people that you are spending that money with may have less customers, right? You know, people may choose a lower level of care if they don't get to deduct the cost of that care. So these are some of the losers. Again, this is one of those rules where it is so deep, and we're actually probably going to do a couple of classes on it to really help people understand in the weeds what the implications are. But the big picture is that the law itself is really going to help corporations be more profitable, and shareholders of corporations should feel the benefit of that, right? I want to take a second and just kind of reflect back on history. This is a chart of 100 plus years of the market returns, and in the late 90s there was a sequence of events where earnings really had one thing after the other that made them go up. You know, it was the technology and the internet, then it was job consolidation, then it was sort of a boom of spending in like the technology space specifically. And then we got to this one point in late 1999, and those of you that invested back then, I know you'll remember this, but we all kind of got to a point where we believed that, hey, our computers and our phones are not going to work anymore come January, like, because the 2000, like, how would the computers process?
Y2K.
Right, Y2K. So there was a catalyst where in the end of 1999, everybody felt compelled to go buy a new computer and a new phone and anything that goes with those. And so there was this sudden run up in earnings. It was a one-time shot of incredible amount of money moving that propelled the market to new highs. I don't want to make the prognostication here that the market's going to fall off the cliff like it did then, but I do want to make everybody understand there's a parallel, right? This new tax bill is a one shot. We're going to bring taxes from 35% to 21%, which has an imputed earnings impact or dividend impact of 15 to 20%, one time improvement. It's not going to change necessarily the rate of growth, but it's a one-time shot in the arm. So the question is, if investors keep pricing this level of growth forward, then do we get into a bubble, right?
And who knows? Last year, and all the metrics that came along with last year, performance-wise, lack of volatility, that's unsustainable.
That's right.
That's a fact.
That is a fact. The price to earnings ratios are higher than they should be. Here, look at this chart. Right, we call this the case for a correction. If you look at the price to earnings ratios, you can look at the forward price to earnings ratios, which are looking at the next 12 months, or you can look at the trailing price to earnings ratios, which is the last 12 months. Look at it sector by sector, and what you will see is that prices that investors are paying right now for stocks in every sector except for technology and telecom are extremely elevated over their 20-year averages. This is extremely optimistic landscape for investors. And that's when you begin to get the larger potential for corrections, markets to pull back 10, 15, 20%.
Well, the way to make money long term in the stock market is to buy low and sell high. This, at least historically, says you're buying high.
That's right.
Okay. So, and that doesn't mean that you wouldn't potentially be able to buy higher. The market could continue to go up. I hope it does personally,
Right.
but I want to be ready if it does not.
So really I think the key piece here, we got a great package that's stimulus for corporate America. On an individual basis, it could go either way. You have to look at the details and figure out is it going to help you or not. But from an investment perspective, we got a shot in the arm here that should propel earnings for the near term even further, despite the challenges that exist. You need to stay invested in it for the long run with stocks. I mean, this chart here that we're showing you, is really important to realize. If you own cash, money at the bank, you own bonds, over the long run, you don't have nearly the opportunity to earn what stocks have made. The problem, is that you cannot sustain large losses and get to your goals, right? If you, on the right-hand side of this page, if you have a 30% decline, you have to make 43% just to get back to even. If you have a 50% decline, you have to make 100% to get back to even. So the question is, how do you do it? How do you stay looking at stocks, owning stocks, but also have a protection mechanism in place? And of course, those of you that know me, we're going to beat the drum here, okay? And I've got to beat it all the time because this is really a powerful time for this. But our defined risk strategy is exactly what we think solves this problem. We're participating in the market at the 200-day moving average. We have automatic stop losses in place where we come out of stocks. It allows us to be in them while things are accelerating, but when we get slowdowns and things begin to deteriorate, we come out, we rebalance into cash and money market and short-term bonds. So if you would like more information on defined risk, obviously you can get it on the website, but we think that's the perfect tool for this cycle. Any other thoughts?
So incredibly timely. I don't know when. You don't know when. None of us do. I think we're all fooling ourselves if we think it won't happen, a market decline. So had a teacher said, if you fail to prepare, prepare to fail. So you want to plan for these things. They're going to happen.
Yeah.
Plan for them now, not in the middle of it. So.
And you don't have to work with us. If you're watching this video and you've got your own thing, you can deploy a trend analysis strategy. Call us, we'll tell you how to do it. Like this is so important for people to understand. This cycle, without this toolkit, without this understanding, you can do generational damage to wealth. If we have a correction and you sustain a a turn down like we had in 2001, 02, or a turn down like we had in 7, 8, 9, they take long time to recover from, and most people don't recover. So having a plan is important. Last thing I'll say, so this is in 8 months from right now, if we don't have a correction between now and then, we will then be in the longest bull market cycle in the history of democracy. So we're getting pretty stretched out on the probabilities of how much longer can it go. All right, we're going to wrap it up with that. We got slow growth, organic. The tax bill is making it so we have some earnings growth. You want to be in and participate, but you need to have a plan for when things turn. We think we've got a pretty good plan. We appreciate the opportunity to serve you and your families. We hope that this call has been helpful. There's a lot going on with this tax law. Call us, email us. We'll make sure to get your questions answered. Anything else?
That's it.
All right, well, thank you for joining us today, and we're going to run through our required disclosures.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information.